All right, so I wanted to do something a bit different here in this video. I was looking through Seeking Alpha. I came across this article, Palantir Value Trap, catchy title. They lay out a few points, and I wanted to kind of walk through this with you guys and give you my insight. Because as you know, I've kind of been, a fan of the company Palantir for a while. I've not really been a fan of the valuation up until recently, and yes, I do own Palantir stock now. So I think it'll be interesting, from my perspective, from someone who's not always been a Palantir bull, to see what this analyst or writer has to say. And maybe they're misunderstanding the company here. Maybe they're overlooking some key details of the future of this company. But we'll dive into that and I'll share my perspective. So, Palantir Value Trap. Let's talk about this. Summary. Palantir is an overvalued government contractor. Interesting. Business has no intrinsic scale value. That's a bold statement. Palantir's revenue growth is estimated at 40% this year, but it's still grossly overvalued. And I'm curious to see what metrics they're using to figure out, whether it's overvalued, undervalued, whatever. But they're right. 40% is expected this year, and remember, Palantir expects 30% plus growth for the next 4 years as well. So let's get into this article here. Quick summary of Palantir. Okay, so first issue: government consulting business with 3 major issues. Someone needs to explain to him or her what the fuss is all about with Palantir. Talk about Palantir unique business cashing in on big data. They don't see it as that. And they say here that Palantir is best known for its various foundries, foundries data management aggregation systems. They go on to say that they've had some success with this type of business. If success is defined solely by sales growth. I mean, I think it's fair to assume if your business is growing, especially if it's growing rapidly, it's seeing a level of success. So I'm not sure why this snarky comments in here, but I think all of us would agree if a company is growing, it's seeing some sort of success, and you can define it as successful. For example, Palantir's 3Q 2021 revenue increased by 36% to almost $400 million. Main source of revenue, government revenues, increased by 34%, while commercial revenues, which include all Palantir business outside of government, increased by 37%. Okay, so we're seeing 30 to 40% growth across the board here with their government, their commercial, and just overall. Now, what's interesting and something I don't necessarily fully agree with is them saying their main source of revenue is government revenues. I mean, yes, you can say that today. That is true. You can't deny the numbers here. However, the way that Palantir is positioning themselves, it's clear that they want to have that commercial part of the business become much, much larger and kind of dwarf the government part over time. Now, remember, the government part of the business has been around for a very long time. It's fairly mature, but it's still growing 30+% year over year, which is impressive. The commercial part is fairly new, only a few years old, and that's also growing 30+%. And I think that has a much longer runway because there's so many businesses that can use Palantir's technology, their insights, and kind of their foundry software. So I mean, yes, today, while you can see here in this image, the revenue from government is a lot. It is significant. It is majority. Commercial is catching up quite nicely. So don't sleep on that. Don't judge the company, in my opinion, by just its government contracts. Look at what it's doing with commercial, because that is where a lot of spending is going to come over this next decade. They go on to say here revenue growth is not a concern. Palantir's problems are much deeper. Okay. First issue of Palantir is that while the company's sales are increasing at a healthy clip, this is not translating into profits for shareholders. Okay, here we go. Profitability. The lovely profitability argument. Palantir's revenue increased by 44% to $1.11 billion in the first 3 quarters of 2021. True. Sales forecast for 2021 calls for up to a 40% increase in sales. That's a good start. What about profit? So yeah, as we're expecting this year, they are expected to grow around 40% year over year with their revenue. Now he says, or she, despite a 44% increase in revenue in 2021, the profit picture appears to be dire. Company lost $364 million in 2021 alone, and the year's not even over yet. Total loss of the year could exceed $400 million. not bad for a company that has been operating for nearly 20 years and grows at 40% annual growth rate, right? Profits after nearly 2 decades of operating appear to be too high for Bar Palantir. So, I mean, this is a fair argument, and this is something that I think a lot of people see about Palantir, and a lot of people choose not to invest in the business because of this, right? You ultimately invest in a company because you believe it's going to be profitable over the long term, because they're executing well, their future looks bright, and with Palantir here losing hundreds of millions of dollars every year, sure, it raises concern, it raises a red flag. Now, my rebuttal to this would be that, Palantir is investing in their people heavily. And when you have companies investing in their people, over time, that pans out to be very, very good. We've seen this with many other businesses in the past. A lot of companies typically will reinvest in the company itself, and they'll have high turnover, and that kind of ruins company culture, company vision, that kind of stuff. So with Palantir here saying, we've trained our folks and we've pretty much put a lot of money into them, and we want to keep them around by offering them stock-based compensation, which we'll talk about in a second. We believe that they'll stick around and they will help grow this business. It's kind of an investment in them now that'll pay off over time. And that's kind of the bet you're taking when it comes to Palantir, guys. You're betting on this company executing over the next decade. Not going to be kind of a turnaround 1 day, 2 day play where you can make a ton of money. It's really a business that you're looking to grow over time, continue on with this 30-40% growth rate. And so far, management is confident they can keep doing that. So let's talk a little bit more here about this profitability, right? So they kind of outline their statement of operations here. They break down their income. And you can see here that a lot of the costs don't really come from cost of revenue because they have high gross profits. You can see here that 2021, 3 months, they pulled in $392 million in revenue. Only $86 million of that was from the cost of that revenue. So you can see how strong their margins here with this, the gross margins, and that gives them strong gross profits. What the company is really spending a lot of money on, guys, is things like stock-based compensation. They're spending a lot, hundreds of millions, I believe, on that for their employees. And they're also putting a lot of money right now into sales and marketing, R&D, and other expenses with the business. So you can see here that the total operating expenses are quite high, but in my opinion, over time, I believe this will level out because these expenses, while they grow, I don't think they'll grow at the same rate that the revenue is growing. So you can kind of see expenses here, revenue here, and over time it grows, but the revenue is growing much bigger, and that expenses piece makes up a smaller part of the pie. So valid if you're concerned about that today, but I don't think that should really be a factor for this company looking 4 or 5 years out. And that should be incorporated into your analysis and into your long-term picture if you're considering Palantir as an investment. Now, moving on here, we can see that the second major issue they talk about is lack of scalability, which, I mean, just based on that statement, I disagree with. We've seen how Palantir can scale. We've seen how they can grow, and they are growing extremely well, with management saying 30% plus growth over the next 4 years. That to me says scalability. That to me says strong growth. They compare it here to companies like Facebook or Netflix. Facebook and Netflix are consumer-facing products. They're going to scale differently than enterprise type products. So I believe this is a pretty weak argument here. They talk about how they can add customers at near zero marginal cost. Sure, because they're consumer facing, and that's kind of the beauty of being consumer facing product. But then it comes with other issues, right? Like consumer facing, there's a lot of turnover. You can't really charge high fees for consumers because they're just gonna leave your platform, right? With enterprise, if you can show a company how you can save them money and how your product is valuable, they will keep spending with you, they will stick with you, and it just makes your product so much more stickier, which is why me personally, I love investing in enterprise-based companies because it's a lot more reliable recurring revenue, in my opinion. So for them to say it's not a sustainable business model here, I disagree. I completely disagree with this. While they have a different approach versus a consumer-facing product, I believe Palantir has a ton of room to grow, a ton of scalability ahead with both government and with commercial, and they're showing that with their constant deals that they announce every so often. The third issue here that we have to discuss is in regards to their operating profitability. So again, this is kind of relating back to their stock-based compensation in terms of them diluting shareholders. And you can see that there's a graph here that shows how much dilution we've been seeing with Palantir stock. And again, I will say to this, it is a concern. Maybe it keeps you away from the company, but my personal stance is that over time, this dilution, the stock-based compensation will become less and less of a factor. And we've seen this with other massive companies as well that have succeeded over time. So I'm not really concerned here. Sure, you can make the argument this keeps you away. That's kind of your preference, and that's what makes the markets so interesting. But to avoid an investment just because they have high stock-based compensation to keep their employees and their talent, I don't really buy into that. I'm not really a believer that that's a deterring factor for me. The last thing in this article, they talk about valuation. I'll give them this. Palantir has been a pretty richly valued company. You can see the price of sales here. Not cheap. But if you guys missed it, I actually made a video recently on my prediction with Palantir on a conservative basis and also a more bullish basis over the next 4 years based on numbers management's given us, based on the free cash flow, that kind of stuff. And I actually think that Palantir today in like the $17-18 range is a pretty good value and is good enough for me personally to keep buying and adding shares into. It's not one of your cheap stocks where it's like, you know, a 3, 4, 5 price to sales and potential big upside. It is an expensive company. I'm not going to deny that. But it's also a very fast growing company, and more importantly, an extremely strong free cash flow company. This company turns almost 30% of their revenues to free cash flow. And right now it's kind of clouded because the stock-based compensation kind of offsets that and it looks like they have losses. But over time, I keep saying this, it's important, that stock-based compensation won't be as much of a factor. The free cash flow will be much, much bigger. And that's when investors and Wall Street and all these analysts will turn around and say, oh, wow, look how much money Palantir makes. I'm going to buy into the stock. And that's when we can kind of see that kind of hockey stick effect in the stock price. So, I mean, this writer, this analyst, they had some pretty, interesting insights. I don't think there's any new concerns here that I haven't heard before. I'll be first to admit that I had a lot of these concerns as well before I spent a lot of time understanding Palantir. I think one of the big issues with Palantir is that it's seen as a government type company when a lot of the company now is shifting to commercial. And I think in a few years, we'll see commercial make up more than government. So that'll be an interesting dynamic. And the other big issue, of course, valuation. It's an expensive company, but if you look a few years out, you can kind of justify that and see why there's still a lot more upside. And stock-based compensation, which again, I've talked about plenty of times in this video. I believe that's a long-term non-issue. So I completely disagree that their business has no scale. I think they've proven scale already. I somewhat agree that it is not a cheap company. Valuation is, it's fair in most cases. And while I technically agree with the fact that they are diluting, I don't think that it's excessive. I think that it's a smart move for them to retain their talent and kind of look long-term for the health of the business to differentiate them from any sort of competitors that may come up. So I don't think it's a value trap. I think it's a great long-term investment. I think Palantir has the potential to be a $100 billion company plus in the next 4 or 5 years. And again, if you missed the video, I'll leave a link description down below. I walked through my analysis, my valuation, my outlook on the company. If you want to check that out as well. Anyways, guys, hope this video was insightful. If you enjoy this sort of content, you want me to make more reaction, commentary type videos on the channel, let me know in the comments down below. But either way, thank you so much for watching. Don't forget to positively, and I'll see you in the next one.